So why do we evaluate financial statements in the first place? Well, first of all, we want to use them internally as financial managers so that we understand our performance. If we can use financial information appropriately, we can determine what are appropriate comparisons between divisions and how should we compensate our managers for meeting goals. We can also plan for the future, and we can see what's happened in the past and how that's going to translate moving forward. Externally, ratio analysis is used by our creditors, by our suppliers. We can use them in conjunction with assessing our customers, but mainly our external use is because our stockholders are going to be analyzing our financial statements using ratio analysis so that they can tell if we're doing a good job or not. Now, as I mentioned, ratios have to have some point of comparison or some context. So we're going to want to perform this kind of benchmarking or context approach two ways. One is with a time trend analysis. How is the performance changing through time? So we would simply calculate, for example, the profit margin for several years and determine, is there a trend? Are we moving in the right direction or the wrong direction, depending on what ratio we're talking about. The second way that we would benchmark is against a peer group or a group of competitors. So we would compare to similar companies and see how our numbers stack up. We did a little bit of this with the Yahoo, Google, and Home Depot, Lowe's comparisons, but you could go much deeper and compare to a much larger group of companies. If you want to try to figure out what companies are good competitors, good comparison points, you could use standard industry code or SIC codes or NAICS codes to determine what companies are appropriate peers. Now, there are some problems with financial analysis that we're probably not going to be able to solve here in this class. One of which is that we may have to analyze some conglomerates. So we may have a company like Apple that does a lot of things. They make mobile phones and tablets and laptops and PCs. They do software. They're into streaming audio and downloadable audio. There's Apple TV. There are some other types of things that Apple does, and it's going to be really hard to find a comparable firm that is competing in all of those areas. So if we have a company that does a lot of things, it's going to be hard for us to get a apples to apples comparison on the financial analysis. The second thing is that we have global competitors, and global competitors are going to be operating under different sets of rules, different laws, different regulations. And so again, the apples to apples comparison is going to be difficult. Different firms may use different accounting procedures, and those different accounting procedures may impact their financial statements in different ways. And so when we do a financial analysis, we have to understand that different accounting procedures are going to impact our analysis, maybe for the good, maybe for the bad. We have different companies may have different fiscal year end. So one fiscal year may end on June 30th, and a new year begins on July the 1st. Another company may end its year on December 31st and start a new year on January 1st. So because of that, because we have seasonality trends and time of year matters, our different fiscal year end may impact our financial analysis. Finally, we may have differences in capital structure. We may not be able to make a great comparison because one firm uses a lot more debt than the other. Some firms may not use any debt. And so that's going to cause a difference on our financial statements that we're going to have to be able to deal with. There are seasonal variations, as I mentioned, but also we want to be aware that one-time events like mergers or acquisitions or some sort of scandal or the release of a life-changing or a company-changing technology or product, those are going to affect our financial statements in ways that we might not be able to control. So financial statement analysis is a really good tool for us to have, and we want to make sure that we can use financial statement analysis appropriately. However, we want to make sure that we recognize that this is not perfect. We are using historical information from our accounting department to try to figure out what's going to happen in the future. What direction are we moving?